I think it's best to get in Bharat Kedia, the CFO of Parag Milk Foods, to talk to investors by and large about what's the way ahead for the company. Bharat, good having you. Thanks so much for joining in. No point in saying that, oh, it was a tough quarter, because it was. It was a very tough quarter.
Absolutely.
The question is, does this pain translate well beyond quarter three?
Yeah, so let's understand what has happened in the quarter. The quarter has gone through three different pains that has come all the way together into one attempt. We had a demonetization in this quarter that led to a reduction in sale for 1 week. The second, we have had a sales tax inspection in this quarter, which caused some exceptional expense to the company. And the third, we also had a raw material price hikes in the quarter, which were very exceptional in the nature of business we are in. For the first one, which is demonetization, the impact is far behind us because we have seen the sales of December and that had been in line with our expectation, and January has been in line with our expectation. The impact of sales tax inspection was one time, and therefore it is classified as exceptional and it is not a consistent or routine nature to come back. There is an impact, which is the impact of the price hike of the raw materials, and that is the impact that we are trying to cover up. What we have done is that we have taken a price increase of our consumer products and our institutional products in the month of January. We could not take the price increase in Q3, and therefore the financials got under pressure. In Q4, we have already taken the price increase. That price increase is still partial. The rest of the increment in the cost we are trying to cover from our internal cost-cutting measurements that are being happening. Therefore, to the extent we are able to get the price hike and cost-cutting work together to curb the increase in the raw material cost is the question that remains open for the fourth quarter.
Okay.
If the fourth quarter goes very well, great. If it doesn't, the first quarter of the next year definitely back in track.
That's because base will be low. So if the base is low, numbers automatically will start looking up, right?
The first quarter of next year would still be compared with the first quarter of the last year, for which the base would not be low. The base is only low in the third quarter of this year.
You're talking about year on year.
Year on
not
year. We are not,
sequential growth.
year on year, we would still have a.
So how significant could the jump be from what you've already done in the previous quarter to the next quarter in terms of growth numbers?
And the broader question is, how are you confident that the numbers will return to normalcy? Because it's consumer behavior, which I presume right now is difficult to predict.
Well, consumer behavior is difficult to predict, but we have our branded product business. That's the beauty of the Parag Milk Foods being in a dairy business which works under 4 different brands and a distribution model. We have led our business from being dairy towards an FMCG company, and the FMCG company's behavior and pattern of the consumer products depends on how the strength of the brand is.
Okay.
We have just got brand health track that shows a amplified performance of our brands. We believe the amount of investment that we do behind our branding strategy that would not let our consumers to run away from us. These are financial issues. These are not top line issues that we had. Our revenue actually grew in the third quarter by 15%.
But how is it that you propose to do that? Again, the same question that Neeraj said, because you've undertaken a price hike, which you say is partial. You are taking some cost-cutting measures, which you feel confident are going to give you the better numbers in the next quarter. But at the same time, you're upping your advertising costs as well. So wouldn't all of it get negated eventually?
No. So advertising expenditure in our company works is that we have annual budgets. The spend is not actually equal in all the fourth quarter, and it is not exactly mapping to the same kind of a growth year on year. Because, for example, in India, various festivities move from 1 month or 1 week to the other because we don't have a calendar days, we have like Panchang days. So Diwali, for example, this year was on 31st of October. Last year was, I think, 11th. So as the things move, we also move our advertising plans accordingly. So the advertising plans of the second quarter and third quarter were more aggressive in this year compared to the last year. However, for the full year, they are going to be the same. And therefore, the fourth quarter is going to be a low quarter for us to advertise. That does not mean that we are running away from the advertising spend of the company. Advertising spend of the company remains committed to the level as it was budgeted before. What it does is that it saves the fourth quarter from a financial performance perspective rather than from a sales impact.
Okay, so let's understand your revenue breakup. You're migrating from being a pure milk company to an FMCG company. Value add is what you're trying to aim at, cheese, branded products.
Absolutely.
What was the breakup of your milk business 1 year ago? And what is your milk business contributing to your total top line? And what are the margins in the pure milk business and the branded business?
So our business is divided into three different categories. Consumer product business, which is the value-add business you talk about. Then we have a fresh milk business, and then we have a commodity business, which is the powder business. Our commodity business last year was about 11% of our total pie.
Okay.
For the first 9 months, it is about 12% of our total pie. Okay. So basically, we are pretty much there where we were, except that the third quarter has an exceptional growth, because in the third quarter of the last year, the commodity sales were extremely low. And that's why the growth looks very, very high. Then comes to fresh milk. Fresh milk has also gone up about 0.5 to 1% in the share of pie. Fresh milk was about 20% of our revenue. It has come up to about 21% of our revenue. So basically, if you look at our consumer product business is 2/3 of our revenue, and it is 2/3 of our revenue even after situation where we are through the demonetization, which has impacted our consumer product business higher than anything else. Our fresh milk business has not impacted, and our commodity business has not got impacted.
But the point is, this quarter, the problem area is not the revenue any which ways. As
Correct.
you yourself mentioned, the revenues have been okay. I think what people want clarity on are a couple of things and would appreciate that. There's, even post the con call, people are saying there's no clarity on where the procurement costs will settle. And people are saying that the price hike that you have taken is not adequate, and that will have an adverse impact on volumes in a downbeat consumption environment.
Okay. So in terms of the procurement prices are exceptionally high. We have not seen these kind of increase in procurement price in last 23 years of our history. Okay. It is not that raw material procurement prices don't go up and down. They do, but they don't go up and down like a stock market yo-yo. It has gone that way. Now, will it come down? We are not working based on it is coming down. We are working on our own organization of managing costs and price increases, assuming they are going to stay at that level, and they are still staying at that level what they were in December. So they haven't come down as yet. We hope it does come down, but if it still stays, we need to manage.
Just so what we move on to the second part, what has been the jump? Can you quantify that?
It is 20% plus, slightly over 20%
in one quarter.
In 4 months. That is starting September to December, absolutely.
Why?
So the raw milk prices have really gone up. What has happened in the situation is that skim milk price have gone up. That is one another reason why our skim milk revenues are up. Skim milk prices have gone up. The demand for milk has gone up, but the supply for milk has actually gone down. So the two things have come together at the same time, which has put pressure on pricing. The pricing in this country, because the milk procurement is completely unorganized, pricing in this country is determined by the buyer of the milk. So as the buyers in the market start to raise the milk prices, everybody will have to, because you cannot do the farmer injustice to the farmer who are very, very small and selling 4 liters, 6 liters a day. So you keep increasing these prices to match up to what market demands are. And that's how the prices have gone up. These prices don't go up in one day. They go up slowly and gradually, and we have seen this continuous growth over a period of about 4 months that it has gone. We attempted to take a price increase in October. We did not do it because it was a Diwali time. It was the most largest volume month for us, so we did not do. Early November came the demonetization. It broke our idea of taking price increases. December, skepticism of demonetization continued in our mind, and therefore we did not take it. January is finally we took that call and took the price increases. In February, most of the competition has followed that price increase, and therefore the pressure of volume that we talk about was very, very temporary for about 15 odd days.
So assuming this milk procurement cost does not stabilize at 20%, which is the way you are hedging your prices at, assuming there is an uptake further than 20%, what is it that you're going to do? Are you going to undertake another price hike? Is it going to be steeper than what you've already taken in the month of January? And will that again impact your volumes? And if so, if you could quantify by how much? Because I'm sure you at your end have also done a worst case scenario assumption already.
Perfect. Sensitivity analysis is part of the MIS that every organization does, and so as we do. So there are various things that we do. First, we are working through various launches of new products in pipeline. Many of these launches of new products are going to improve our margins from where we are. Therefore, not necessarily every increase in raw material price, we have to pass it on to the market. What we also have to do, we have to remain conscious of the fact that consumer can only afford so much. And when you have your products which are purchased by the consumer based on your brand strength, you only want to take a step-by-step price increases rather than going one go and kill it out. And therefore, we are not looking if the raw material prices further goes up immediately to react and give a knee-jerk price increases. What we are looking is how do we improve our margins through our new products. We have recently launched, we had a launch release only yesterday of a new product under the whey protein consumer, which is the consumer whey protein. This is one such product which has come to our company with the highest margin. This is a product that is created out of the waste. So when we make cheese, something goes the waste water that is converted into a product sold, and we are putting an MRP of that product for 900 gram pack of about 3,200 rupees. That's the kind of a value addition that we can bring to the organization as we mature more and more into this business. Now we can do it because now our cheese business is about 32% market share into the country. As our cheese business has grown to a scale and size, we can bring that kind of a value to the market. And these are certain initiatives we are taking. We are also working on milk-based beverages. So we are working on certain initiatives to combat some of these increases. However, that will come a quarter to quarter in pipeline. They cannot just go all of a sudden, and therefore long run we are very well positioned to take care of some of these things. These are only short-term hiccups to our organization.
It's fascinating to live and learn how complex the entire supply chain of the milk business is. You know, I'm so accustomed to getting my milk early in the morning, I never realized that the supply chain, when it comes, it's so complex. Okay, price hike, no price hike, raw material, wherever it moves on. FY18, what should we expect? You've learned from FY17, you've learned that you know how volatility can hit you. Now for a shareholder who bought your stock in the IPO level, they're saying, okay, did I go something wrong? Others are doing well, how come your company is not doing that well? How would you reassure them? Give me a number which will comfort them, which will ebb the selling down in your stock.
So let me put this way, pain is temporary, success is permanent. I've
read that line before. I want numbers.
we have gone through a quarter that is painful to us as it has been to our investors, and we are very pleased to see our investors are still patient to give that time to the management to work through this time. Our FY18 projections, while they are still not confirmed and projected and confirmed through the board of directors of the company, we do not see at this stage that in our projections the growth rate that we had stated before would likely to modify. We still believe and have the confidence that the growth rate that we projected in the past shall continue to be there in place.
Which is, if you can give me a number there.
So in the past we have already stated that our company is looking at a 14% annual growth in the top line, and our PAT margin to improve from 2.9% to 5% plus over a period of 3 years.
Okay, just one question on, your protein business as well. How much revenue do you expect from this product, whey protein, and what is the contribution to profits that you're expecting?
So whey protein market is about 1,000 crore market, and this is a consumer market. The overall whey market is very, very large. And we are looking at that we should be able, with the plan that we have in hand, in 4 to 5 years, we were looking at about 20% market share of this product.
Okay, I just have one final question. So you will grow top line to the tune of 15%, which I'm sure you will, because this quarter was also not bad. What about EBITDA and bottom line? Brokerages have cut their estimates. I'll read out one of those, Bharat, and maybe you respond to that. They've said that they are cutting their EPS estimates by a sharp 37% for FY18, PAT estimates by 37% for FY18. If you grow your top line at 14%, what would the proportionate bottom line growth be for FY18?
As far as we are looking at our business as we speak right now, we see there should be no reason for us to cut any of our targets at the bottom line. We believe that the things that had been like demonetization, sales tax and pricing, these are an impact of these financial year.
Okay.
And by the time we close this financial year, the tough time should be behind us.
So you will grow at 15%.
And that's our view. Well. Having said so, obviously people in the outside market have their own intelligence to assess how the company is going to look like.
No, of course. So you will grow at about 15%. You believe there's no
we
reason
believe
not
there's
to
no
grow
reason not to grow. Correct.
From the FY17
For
base.
the FY17 base.
Okay, we do hope that things improve sooner rather than later.
Absolutely.
It's a tough quarter for you. All the best for the quarters ahead. And thanks so much for joining in today.
Thank you very much.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.